The Federal Reserve raised interest rates by 75 basis points this week, but they're not going to stop just yet. In fact, they're going to continue to tighten monetary policy until something breaks in the economy. And I'm not talking about what we've already seen. I'm talking about what we haven't seen yet. More things are going to break more dramatically. More pain is going to be ahead. That is according to our next guest, Lobo Tiggre of the Independent Speculator. It's been a while since we've had Lobo back, so we're going to run through the gamut of topics, including macroeconomics, gold, how to invest in commodities right now, and stay tuned. Near the end, he's got some juicy memes to show you regarding Elon Musk and Twitter and the Federal Reserve. Welcome back to the show, Lobo.
Thanks, David. Hello, audience. Kind to see you.
Good to see you. It's been many months. Many new developments have happened since last year on the show. For the audience watching this right now, stick around to at least, halfway through the interview. We'll be getting your forecast. We'll be getting your forecast on gold. I say halfway because we have a lot to discuss today. So I plan to run the gamut with you. Let's talk about the Federal Reserve first. This week, Fed raised interest rates by 75 basis points, largely expected by traders in advance. But as you pointed out to me offline, markets seem to have reacted as if no one expected anything of the sort. So walk us through what happened.
Sure. I think this is actually more telling and more important in ways than people may realize. Of course, it seems to make no sense. Like the Fed did pretty much exactly what was telegraphed. They raised 75 basis points. They did what was expected. So what was the big kerfuffle? And the kerfuffle actually cuts both ways. When the press release from the FOMC first came out, the markets took off. They went, major green, across the board. The major indices, gold was up, because there was the appearance of opening the door to the step down, to the slowing, the eventual slowing of the rates that everybody knew had to come sooner or later. And then, as so often happens, the moment Powell opened his mouth, the markets tanked. They went up and down. I posted a chart, and this isn't just some meme out there. I actually wrote down timestamps for when Powell said different things, watching the market go up and down. And I annotated the market turns and what Powell said that made the markets turn, which it did several times. And it ended up down. So here's my take. A lot of journalists and a lot of talking heads on Bloomberg, maybe even Kitco, other places, were asking, how is Powell going to thread this needle? On the one hand, everybody knows that the Fed can't be raising rates 75 basis points forever, but they don't want the markets to get giddy and take off, so they have to balance that in some way with some kind of negativity. And how are they going to manage this? So the answer was to put the good news in the press release and then have Powell come and play bad cop and beat up on it, beat the market with his jawbone until it went back into the red, which is exactly what happened by the time he was done with it. So, the key things that he said on this and how he jaw beat the markets down was it basically admitted that, yes, that there would be a point where they would have to slow down the increases. Oh boy, the market took off again. But then he said that rate of increase is really not what's important. It's the terminal rate and how long they maintain rates higher that are more important, and that terminal rate is likely to be higher than previously anticipated. So that was more bad news. That was not already priced in, and I think that's why markets reacted negatively. Now, the takeaways from this, I'm not going to add to the tea leaf reading. I'm actually more looking at the market reaction than the Fed reaction. I mean, I see the Fed as in that tight space. It's painted itself into a corner. It has to keep things tight because inflation hasn't cooperated yet, but it also knows that it's going to break something. So I think the important takeaways for investors are that despite the easing talk that the Fed put in there to give itself room to pivot if it has to, Powell very clearly answered the question more than once. What are you going to do if push comes to shove? Is it going to be the economy or inflation? Are you going to err on the side of doing too much or too little? And he very clearly said doing too much. And the reason why he quickly reassured the audience that, but don't worry, we have the tools to step in and support the economy if we go too far. In other words, they're planning to go too far. They will go too far. That's the default program right now. But don't worry, we have the tools. We'll fix it. Of course, this doesn't reassure me very much, David, because before when they were saying, don't worry about inflation, there's no inflation, Or then, oh, it's just transitory, but don't worry, we've got the tools, we can fix it. Well, guess what? That toolbox hasn't done a great job so far. And it worries me to hear him talk about pushing the economy too far because they've got the tools. Takeaway, David, is, you know, I hate making big, bold predictions, but here it is. You've got me to make a big, bold prediction on Kitco News. The Fed is absolutely going to break this economy. I think they will push it until something breaks in a big way, and there will be pain.
I'm going to come back to that. But first, let's talk about your chart here that you showed. So yeah, markets did seem to take things by surprise. Now, the efficient market hypothesis states that markets react to all available information. So clearly, there was some information that was not available to the public unless you're on the Fed inside. What do you think really surprised the markets? Was it the fact that Jerome Powell indicated that interest rates would ultimately go higher than expected? Was it the fact that maybe, to your point, they might not stop until things break, meaning their tone was more hawkish than expected? What exactly was the thing that took markets by surprise? Because it wasn't the 75 basis points that was priced in.
Yes. Actually, I think the surprise was the language about the Fed's awareness that there's this lag, and that was discussed by Powell in the meeting. He thinks the lags are not as long as in Friedman's day, but there are lags, and that they understand that the effects of policy already done are cumulative. So putting that in the FOMC release really did, if not actually look dovish, it sort of opened the door for the doves to come back on the stage, if you will. And I don't think people expected that. The rest of it really wasn't surprising in my view. It was more, the surprise was in the FOMC statement, and that's why the markets went vertical at that time. And then Powell trying to beat that back so that the markets wouldn't ease conditions in contradiction to what he's saying. But I'm glad you brought up the efficient market hypothesis, because I want to say something about this with all due respect to your friend, the professor there. It strikes me as very ivory tower. And yes, you can look at this in a sort of average way. And in a way, the efficient market hypothesis is sort of backing what Buffett says about, just bet on America and, managed accounts and stock picking. It's not, you're just better off just going with the S&P 500 and betting on America, just going with the average. In a way, this is like the efficient market hypothesis. You're bringing in all the market players, and that information on average works out to better than you can do on your own. But clearly, looking at that chart, that's not an efficient market. I mean, that is an insane market. I'm not a medical doctor, so I can't diagnose it as schizophrenic or bipolar or whatever. But just look at this. That thing goes crazy nuts up, crazy nuts down, crazy back up nuts again, and then down again. Basically, with the Fed having decided to do what was entirely known in advance. It's all the detailed nuances in the tea leaves there that made for these insane responses. So clearly the market is not that efficient. And more to the point, I think, for resource investors, and particularly metals and mining investors, and analysts like me, is there's so much information out there that is just ignored or not available to the broader market. The market is very inefficient when it comes to niche markets. I would say that the more niche, the more focused your investment is, the less applicable the efficient market hypothesis is. And I'll just give you one example. When Warren Buffett bought shares in Barrick, if you remember Barrick, the ticker in the US is gold, GOLD, because they bought Randgold and that was their ticker. And just so happens that on the Canadian exchanges, another company has that same ticker, GOLD, on the TSX is a different company. And when it came out that Barrick got Warren Buffett's stamp of approval and people piled into Barrick, the same day, this other company, completely different company, Warren Buffett didn't touch it, but it had the same ticker on a different exchange, and that stock went nuts at the same time. That's not an efficient market. That's a crazy market making obvious mistakes, newbie mistakes. Even if the information is there, they don't look at it. So final point here, my main number one mentor was Doug Casey. He taught me how to be an independent speculator. And one of his main points is that markets are irrational. As the saying goes, they can remain irrational longer, you can remain solvent. But this matters to us as a speculator because they're irrational, because they're emotional, they overshoot. in our audience, I'm sure they have seen a gazillion times, markets overshoot, they get overbought, they get oversold. And because that happens, because price and value diverge inefficiently, there's opportunity for speculators to pick up value that's underpriced or go short on overpriced, misvalued. So my point here is that I think we saw just evidence in spades yesterday about how inefficient markets can be. But the good news is that people who understand this and who know how to play it in their favor can use this market inefficiency to make money. That's the essence of what Doug Casey taught me. And that's the essence of what I try to do for my clients at independentspeculator.com.
Well, you're right about Warren Buffett. He actually didn't agree with the efficient market hypothesis. He argued against it. He made himself a case. He made himself a case study. He said, well, if the markets are fully efficient, how am I able to outperform?
Fair enough. But he also does say that for most people, right? Just go with the average. And so, maybe that's true. But if you're looking for, extraordinary, if you're going to speculate, right? If you're a retired person on fixed income and you want the lowest risk portfolio, maybe adopting that Buffett version of the efficient hypothesis and just going with the flow, maybe that is the best thing to do.
That is true.
But if you want to bag big gains, sorry, go ahead.
Well, we're going to talk about mining stock later because that is your specialty, and you're going to maybe give us some insights that might help us, beat the mining index. But yes, so let's finish up on the Federal Reserve. We can move on to the topic. So your outlook on the Federal Reserve, you said that they're going to raise interest rates until they'll break something. So I got to be more specific with my questioning then. How far do you think they'll raise their interest rates? And at what point do you think things will start to break? Because Jerome Powell did say that he will raise interest rates to be sufficiently restrictive, were his words, such that inflation will come down to 2%. At what rate do you think the Fed funds rate needs to be? What level does it need to be for inflation to be at 2%?
Yeah, it's quite interesting. So first, I didn't actually say they'll raise rates until things break. I said they'll keep things tight until things break. And that can mean even after the pause. Right? It's a good distinction. But he was asked in the press conference, why the Fed doesn't have to take the interest rate above CPI. Like that's normally what you would think of. If you're going to tame inflation, the interest rates have to be higher than CPI to bring it down. Other people harp on this all the time. And Powell acknowledged that that's how things were in the past, but maybe, he clearly doesn't think that you need to do that anymore. Mm-hmm. He's also forward looking, and he's thinking that if CPI starts coming down, then you're going to skate to where the puck is going to be, not where it is. But the main thing for people to remember is like this, there's people out there, some people who live on the island that I live on, saying that, CPI at above 8% means that interest rates should be 9% or higher. But that's not what the Fed is looking at. And Powell said this specifically, they're looking at the PCE, which came in high at 5.1. But the difference between trying to get an inflation rate of 5 down to 2 is massively different from trying to get an inflation rate of 8 down to 2. So the goalpost there is not the one most people are looking at, is an important point.
Okay.
Trying to drop inflation 3% is much more manageable, it seems, and it gives them wiggle room. So, okay. To answer your question, so I don't have an interest rate that I think they will raise to. I think we're already seeing jockeying on the goalpost. I think it's likely that something like 3% will be the new 2% or good enough. Given, acute economic circumstances, I think 3% could, or 3.5% could easily be the new 2%. And if at that point, just base effects alone and some of the supply chains being fixed brings inflation down from 5, core PCE down from 5.1 to 4, well, then the difference between 4 and 3.5, that's not so much. They could declare victory at that point and try to, pay more attention to the pain that they've caused. So rather than predict an end inflation rate for you or an interest rate for you, Powell himself has said that, the rate of change isn't really what's important. It's the terminal rate and how long they keep it there to meet their goals. So my big prediction, if you will, David, isn't a number there, but that I do think that they will break things. I don't think inflation is going to come down as easily as they say it will. And I think that there will be a lot more pain, and they're going to remember that they have that dual mandate and that jobs, they make this argument about how, well, we have to tame inflation for jobs to be secure in the future. Well, if masses of people are getting laid off now, they're not going to worry about jobs in the future. They want jobs taken care of now. So I don't know when this happens exactly, David. I think it happens in 2023. Maybe not at the beginning, but I'll be very surprised if we get too far into 2023 before there's real signs of pain and the Fed starts talking about remembering its other side of its dual mandate.
What do you mean real signs of pain, Lobo? Can you be specific as to what things will break?
Well, look at the guidance that we've seen from some of the tech giants just recently over the last week. You've got, Microsoft and Google and these other companies. People, they missed on their earnings reports, but what really shook the markets was their guidance going forward. People thought that Q3 was going to be the bottom or as bad as it's going to get. And the companies were saying, no, we think Q4 is going to be worse. And we're worried about 2023. So I think we're going to be looking at large layoffs. Those really haven't come yet, 500 here, a couple thousand there, or smaller companies. But I think we're going to see mass layoffs. I think you're going to see companies pulling in their horns as, what really in the past would have been normal interest rates. We're not really trying to go Volcker here. We're trying to normalize interest rates. But I think that will cause all kinds of things to break in an economy that's been used to zero interest rates for far too long. So a lot of things can go wrong, and that's not even mention the war and the new Iron Curtain and all that other stuff. I think just internally to the U.S., I think higher interest rates will affect earnings, will affect revenue, will cause mass layoffs, and I think we'll see that in 2023. And I think that will cause a change in policy.
Okay, unemployment was, double digits very briefly during the pandemic. Is that something we'll see again?
Unemployment, yeah. So it's interesting that they're not mentioning this so much now because the employment, I liken the Fed to being standing on a one-legged stool, and they've tossed the inflation fighting rope over the beam and they've got it around their neck and they're tottering up there on this one-legged stool and they're saying, oh, this is perfectly safe because this leg is so strong. And that one leg is the employment market. That's, all the other signs of softening in the economy, all the, cuts and guidance and all this other stuff going on. No, it doesn't matter. We've got such a strong labor force. Everything's fine. But what if that's not true? And I remember back in 2020, even Powell would admit that the official unemployment rate really understated the actual unemployment rate. And he still does grudgingly admit that there is an issue with the labor force participation rate remaining so low. So I'm deeply skeptical that the unemployment rate is actually as low now as claimed. I think it's unrealistic to count people who've given up looking for work as not unemployed. Things like that are a big problem, David. And if you add to that layoffs, now we may never see double-digit unemployment numbers the way they count them. But who believes these government numbers anyway? Not even Powell all the time. So I think the reality will be pain. And I would say it would rival what we saw in the 1930s, except that it'll be disguised. Like nowadays, really? You don't have to stand in a line to get soup from a soup kitchen. You get a credit card from the government or a debit card. I don't know what kind of card it is. You get a government card and you go to the supermarket like everybody else and you buy your government assisted food. So it could be that things get much worse, but they're not so visibly bad.
Let me just break this down. If they're not visibly bad, Lobo, I don't want to misinterpret what you mean. If they're not visibly bad, why would the average American need to worry?
Because the average American will have less money to spend. A lot of them will have no money to spend.
That's visible, right? I mean, I can't.
Okay. All right. But all right. So what I mean is because I'm not trying to be too shocking here. I'm trying to be as honest and realistic as I can. I mentioned, get it, but I mentioned the 1930s, and that conjures pictures of these long lines of these drab men
Yes.
in their, hats and their overcoats in line for the soup kitchen and so on. I'm saying that the pain will be potentially on par with that, but you won't see those lines. And you may not even see tent cities or cardboard box cities the way you used to, because of the different levels of government assistance now that were created after that last unpleasantness. So, Doug Casey's Greater Depression could in fact be starting now, as he says, but it may look very different. But that doesn't mean that the person, in a shelter or in some government housing, living on food stamps that now look like a credit card, the despair that person feels and the hopelessness, the health impacts and the decision-making for businesses when, customers are just not lining up to buy their wares or services. It's still a very, very difficult situation.
Okay, let's talk about exactly what's going to happen to financial markets in this very difficult situation that you mentioned. I've heard very bearish forecasts for the foreseeable and distant future. The worst case scenario I've gotten is that, and several people have told me this actually, is that the stock markets will not recover to its previous all-time highs, which was the end of 2020, or 2021 rather, until 10 years later, Lobo. So basically, we're going to get a repeat of the 1930s to the 1950s, as well as, recall the NASDAQ also saw, I believe, a 13 to 15 year period stagnation after the dot-com bust of 2001. So that's going to repeat, according to some analysts I've spoken to. What are your thoughts?
All right, so first, a little more excitement here. Again, not wanting to make a big, bold headline for you here, but I do think that prices have yet to fully price in what you and I are talking about now. Now, does that mean that the Fed will break the markets, that the something that breaks will be the market first, a la 1929? Maybe, but maybe not. It could also just be a relentless grind downwards for years ahead, where things just keep getting worse and worse and worse without, a single large cliff that it falls over. Either one of those, I think, is quite possible. It might be that there's a, wake up moment of holy cow and the markets just really crash, or it could just be that things just, they fall and they can't get up, as the saying goes. So, and I think that starts now. I think we may see bear market rallies, but they will be rallies on a downward trend that I think will endure for years. But I think it's important to throw in here that monetary policy is not the only policy we have to contend with. There's fiscal policy too. And if the response from the other part of Washington is, oh, a recession is no fault of the people's own, let's send them stimmy checks, you could see a great deal more inflation with this recession, a stagflationary recession. You could see prices of commodities and assets go up. So you could actually see the Dow and the S&P 500 hit new nominal all-time highs in the midst of devastation, but that would be a new bucks. You'd have to inflation adjust them. Hear what I'm saying? Like if a neo-dollar is rightly, something that you might chop 3 or 4 zeros off of, you could see the Dow hit new highs, but not if you chop the appropriate number of zeros off the dollars.
Sorry, what? Not say that again?
Okay, so if a dollar today is worth like 7 cents from a 1970 dollar, or whatever the number is, right?
Okay.
You'd have to chop, for a $1 bill to, you'd have to chop like a zero off would be like 1/10, and then you chop, 7/10 more. You'd have to chop a couple of zeros off for a dollar today to be worth what a dollar was before, if you adjust for inflation. I mean, think about countries that devalue officially, right? The Mexican peso, it's trading for 20,000 to the dollar. And then they do an official devaluation and they chop 4 zeros off. Now it's trading 2 to the dollar. Yay. That's what I'm talking about. The official US won't ever do that. But the reality will be the equivalent of chopping zeros off. So you could see a Dow 50,000, but it would actually be the equivalent of Dow 5,000 today.
I see. You made a number of memes actually on inflation and how the Federal Reserve's handled inflation and and the balance sheet. This one here I particularly like. You got a picture of Janet Yellen here. I see no way in which inflation is a decade-long matter. Janet Yellen, June 2022. Okay. I mean, to be fair, that was a relatively recent statement. We haven't seen it we haven't seen 10 years play out yet, but you did show a chart here in the backdrop of the CPI index climbing significantly since the last 40 years. Yeah.
Right. Yeah, and like that, the other one I like is Christine Lagarde, who's saying, "Oh, inflation comes out of nowhere," even though for years you see this rising, tidal wave of inflation, especially ramping up in the last couple of years. It came out of nowhere, and I'm not making this up. These people said these things.
It came out of nowhere. Well, maybe I don't. I'm trying to understand here. Maybe she's referring to the inflation from after the pandemic. Not the past 20 years or so.
Yeah. If we're going to, I'm trying to be fair here and even-minded. And the actual quote, if you look at the entire context, she's actually blaming Putin and the war. She's saying, oh, inflation wouldn't be the problem it is now if not for Putin and his evil ideas. But this ignores the fact of, all the all the COVID-19 shutdowns and the interventions as a result of that, and what that was doing inflation before the war started this year. So I mean, these things are crazy. I mean, it's kind of like, the administration in the U.S. talking about how the war is, it's Putin's oil tax, right? The oil prices are high all because of Putin, but they were high before the war started. Inflation was high before the war started as well. So sorry, but I think even as fair as I can be, these people are scapegoating. They're cherry picking the data points, and they're trying to blame anything other than their own policies for what's happening right now. And I think it's disgraceful.
Okay. Some other memes I want to go over with you. Nothing to do with economics in particular, but how do you feel about Elon Musk and his buyout of Twitter? Got this colorful exchange between Musk and AOC here. She tweeted on Twitter, LMAO, laugh my ass off at a billionaire earnestly trying to sell people on the idea that free speech is actually an $8 a month subscription plan, to which he replied, your feedback is appreciated, now pay $8.
So I got to side with Musk on this one. And, I get the libertarian argument about how Musk took government subsidies to help get Tesla started and so on. And there's a lot of people that hate him for various reasons. And I got to say, the guy sticks his foot in his own mouth often, and he says things that are pretty cringeworthy. But I'm going to side with him on this. And by the way, I love SpaceX. I mean, forget, if we had to wait for NASA to get us to Mars, I don't know, we'd be talking about next century. But now we might be there in 5 or 10 years. So I like the private sector charging ahead there. But on this particular issue, I think it's immensely hypocritical. And by the way, I'm not an AOC hater. No. I'd actually like to meet her and talk to her and find out what she really thinks and believes. But in this case, this is clearly political grandstanding. He's not charging $8 for free speech. I liken the Musk proposal to being like a toll lane on a highway, right? You don't have to use the toll lane. The rest of the road is still there. It's still free. Nobody's being charged to access Twitter and share their thoughts with the world for free if they want. But, it's congestion pricing. If you're a heavy user or if you're using it for business purposes, the way I am, by the way, I'd be happy to pay $8 and have a verified account. And it might help me fight off the scammers and the imposters out there that are so difficult to fight the way things are right now. So, and it's impossible that anybody who even, you don't even have to be terribly intelligent to see this, to say that Musk is charging $8 for free speech is just wrong. It's so wrong that it's hard not to call it a lie. So I'm with Elon on this, and it just strikes me as massively hypocritical when, as Elon pointed out, she's selling merchandise on her website. You can pay $58 for a AOC sweatshirt to support her cause. Well, why can't Elon? This is a private business. Why can't he sell access to the express lanes to help support the network? It makes sense to me.
Well, here's my argument that I'm going to throw your way. I had this discussion with a friend at work, actually. I have no problem. Well, I do have a problem. I don't like paying for things, but especially when things are used to be free. But anyway, $8 a month is not unaffordable for most people, including white-collar workers like myself. But my problem is that before the Twitter verification checkmark, the blue checkmark, stood for something. It stood for a certain status. You had to be either a public figure or work for a media company or work for the government or have had noteworthy influence according to their verification qualifications. You had to apply, go through a process and whatnot. Nowadays, after this change, supposedly anybody, even somebody with 3 followers, can just submit their driver's license, apply, and pay $8 a month for it. It's not something you had to work for anymore. It's something you can just pay for. That's what I have a problem with.
All right. Well, first, do you know that that's true? All I've seen is a tweet from Elon saying, what if we charge $8? How do you know that they won't still go through these other verification steps, or they could even have waivers for nonprofits or things? This is an idea, not a policy. So who knows how it will be? And I also understand that Elon has suggested secondary badges. So there could be badges for journalists or business persons or whatever. I think that's appropriate. I would say at the end of the day, the badge system, the way it was broken. There are many horror stories out there of people, influencers with large followings who couldn't get the badge. Famously, Peter Schiff from Puerto Rico, 500,000 followers and couldn't get a badge. And others, of questionable social value who did get the badge. So I would say that the system maybe had an ideal before that was laudable, but it was broken. It wasn't working. So redefining the badge, making it something else, not what the ideal was, but something that works, and maybe applying different technology to recreate that functionality in other ways could be a good thing.
Okay. Would you opt in for the service, Lobo? It does include a lot of other benefits as well.
They would. Yeah, I haven't actually even paid attention to that, but I've had a problem with Twitter where I've had scammers, like actual criminals, duplicate my webpage and spell my name with one letter different to try to con people into buying things. And I tell Twitter about this, and they're like, oh, there's nothing wrong with that. Their robot is so stupid that it can't tell an obvious criminal activity. Whereas if I have a verified account, maybe I'm nobody, maybe I'm not as important as these other people, but I had to supply payment information, driver's license, whatever. At that point, the robot should be able to tell who's me and who's not me, right? Only my account would be the verified one. And hopefully that would protect people from scam artists who are using my face, David, to try to steal from people. Like I have a big problem with that. And if this new system helps cure that, I'm absolutely all for it.
Don't you think this sets up a precedent for all other services, either public or private, to charge people for KYC? I mean, imagine other social media companies also charging you a monthly fee to get verified. You don't have to use it, obviously. Nobody's forcing you to use it. You could, by the way, that's a sign that you've made it, that other people are, that are copying you, being imposters. They want to be Lobo Tiggre. It's a sign that you're influential. Congratulations. I don't have any imposters myself. I got a blue check mark.
I've heard that, but David, they're criminals. I mean, they're trying to steal money from people.
I understand, but this is my argument. Getting a check mark doesn't remove the criminals. It just means that people are less susceptible to, getting scammed. But Twitter still needs to remove those bots, right? They still need to physically remove those imposters. They're still there, regardless of whether or not you have a check mark.
Yeah. Well, I'm hoping this will make that process easier. Sure. I mean, the problem is that you've got millions of users, right? So, and human judgment could instantly spot these imposters and boot them, but you don't have time to scan millions of accounts. So you have to have your own bot that can do this.
Yes.
So, but let me actually address the question you were starting to. There's a social good here, and Elon has said that he's bought this at a terrible price because it's more than just about the money. Now, he does want it to run as a business and be self-supporting, but he said it's more than about the money. So I think it's premature to say that, Twitter under Elon is going to become the evil empire and it's going to destroy free speech and everything. I don't know, Elon. I don't know what he's going to do, but let's give him a moment. Let's see if he will walk the talk that he has given. And it could be something better. But let's step back to the internet more broadly. I'm a due diligence guy. I kick rocks, okay? That's what I do. I evaluate mining stocks. But on this, my thought is that the internet is so full of scams and crooks. I mean, just think about the spam that you get. You hopefully don't see too much of it because your email filters all these lies, deceits, attempts to steal from you into your spam folder. Like, if you actually look at it, it's hundreds or thousands of times per day that somebody's trying to steal from you. Now, crime is nothing new in the world. Like Game of Thrones, the world's been a vicious place for all of history. I get that. But what the internet does is it brings criminal activity, if you pay attention to it, into your face on a daily basis all day long. It's kind of depressing, David. It's horrible. So it seems to me that all these geniuses out there, these tech geniuses, maybe there's a way to use blockchain or some kind of non-government, non-big brother, decentralized proof of who you are system, not just blue check on Twitter, but sort of something that protects your privacy, but gives you ownership and responsibility and accountability for what you do online, so that we can rein in the crooks, rein in the spam, and so that honest people interacting and sharing information out there can do so without having to wade through this muck up to their hips every day. I mean, it's just the internet as it is, if not broken, it is deeply inefficient. It is full of all kinds of bad mixed in with the good. And I'd like to see it improve, David.
All right. Let's finish up on the mining sector. The internet is inefficient. The stock markets are inefficient. Are mining stocks inefficient now, Lobo?
Yes. And the answer is yes.
All right. How do we
Um,
identify these inefficiencies and profit from them?
All right, so let me set the context here, and I
Okay.
think this is really important, and I'm glad you brought it up, because we've been through a phase here. Commodities go in cycles, these stocks go in cycles, and we've been through a phase where commodities prices, metals prices in particular, took off well ahead of input costs, and the companies were able to do better. The responsible ones, the better ones, cleaned up their balance sheets, and things got better, and people were able to report earnings, distribute more dividends to shareholders, or help shareholders via buybacks. All kinds of good things happened actually over the last couple of years, despite the pandemic. But now we're at a place where input costs are starting to catch up. The inflation that we see worldwide isn't just showing up at 8.2% or 9.1% or 10.7% if you're in Europe in mining costs. It's not like that. You look at the statements that you're coming out of producers and even the people building their mines, and suddenly, the COVID restrictions and the higher costs on steel, and some plant that would have cost $100 million now costs $200 million, or your reagents for your plant to the cyanide and the other stuff you put in the tanks to get the gold out. It used to be, let's say, 5% of your margin. I'm just making the number up. And now it's 10% of your margin. These are massive cost increases. So what I'm saying is that this is a time to be extremely careful, and particularly to the Buffett admonition or the efficient market hypothesis. I think this is not the time to invest in ETFs in the mining sector. It's a terrible idea. Or just going with the average or whatever. I think you need to be very selective. I think you need to be a stock picker. And sorry, I've got some bit more bad news here. I do think, as I was saying before in our conversation, the Fed will break something.
Mm-hmm.
I think we're absolutely headed for recession. I think the global recession is already shaping up. We see it in the UK. It's writing clearly on the wall in Europe. And I think the US is headed that way too. That is bad for commodities. It's always been bad for commodities. Metals prices take it on the chin. And we could argue about how fiscal policy is going to boost metal prices, or the Green New Deal and all the batteries are going to boost metal price. You can make lots of arguments, and maybe they're right over time. But the immediate response to recession is lower metals prices. And I think that's what we see ahead. So as much as I love commodities and I'm a metals and mining guy, right now for metals writ large, industrial metals, I'm not buying anything right now, David. My shopping list is completely blank from that. The only thing I would buy right now, like right now, is a great uranium stock that I might have overlooked before, because I think that is very separate. And we can talk about that or not as you like, but just putting that out there. As for gold and silver, they're not just commodities. They're also monetary metals. So I'm more optimistic about gold and silver, but they have had a bad year so far, and that has the stocks on sale as well, which means that they're subject to tax loss season. Now, since these aren't just industrial metals, I actually see that as a nearer term opportunity. Like today, David, if after we get off this call, I was informed that I overlooked some fantastic uranium stock and it was on sale, I would be willing to buy that right now. Gold and silver, I'd probably wait till next month to peak tax loss season in December and see, what the cat drags in. It could be that there's some terrific companies being selective again, not buying the average, not buying the ETF, but looking at the guys that did clean up their balance sheets or that did secure fixed costs for their mine building project, or that they're an explorer and they secure 2 or 3 years worth of funding and they can work through whatever downturn in the near term. Stocks like that go on sale during tax loss season in gold and silver would interest me in December. Right. But copper and industrial metals, other commodities, not until we see the shape of the recession, probably not until next year. Oil would be the one sort of between uranium and other commodities, and it would depend on how things shape up. But even oil, I'm not looking to buy oil right now, even though I think triple-digit oil prices will be the new normal. The recession, can't overstress this. I know there are optimists out there, and I know we want to believe in our mining stocks, but recessions are always bad initially for commodities writ large.
All right. Lobo, that was a very comprehensive interview. Thank you for your time. I think we'll end it here. Let's save uranium for another time. Tease the audience. We can't give away everything in one interview. And of course, we didn't go over the exact mining stock picks you have because that's on your website, theindependenspeculator.com. People can subscribe to your service. So thank you again for coming on the show. And if you're watching this, thank you for watching Kitco. I'm David Lin.